This is Adam Sliver Trade, and today I am going to take everybody through 12 bullet points that are crucial for your trading. So, I always talk about levels, I'm always talking about psychology, building your own rules. Now, these right here are notes from Trading in the Zone. These are not from me. However, I speak to these all the time. And these are what help me, number one, build my strategy, but help me teach others how to build their own strategy. And everybody who's trading, whether you're day trading, swing trading, these are probably the most important rules that you can, use to put together your own strategy. I love the book Trading in the Zone. It is probably the most important trading book in my opinion, and many people have read it. So this is something that probably a lot of you have seen. However, I'm going to give my own personal opinion on these topics. Uh, because they're so important to me and because they're so important to become a consistent winner, I believe that it's very important that we dig into these more than any other part of this book. So, first off, I am a consistent winner because, right? I'm going to read through all 7 of these and then I'm going to dig into each one. I objectively identify my edges. I predefine the risk of every trade. I completely accept the risk or I'm willing to let go of the trade. That's one of my favorites because it kind of has 2 parts to it that I'll definitely speak to. I act on my edges without reservation or hesitation. I pay myself as the market makes money available to me. I continually I continually monitor my susceptibility for making errors. That one is a mouthful. I understand the absolute necessity of these principles and of consistent success, and therefore I never violate them. So I want to start with number 1. Okay. I objectively identify my edges. Notice this says objectively. This is not subjective. Okay. Subjective meaning, okay, it's personal interpretation. Objective meaning there are a set of boxes that you must check in order for this to be considered an edge. Okay, great. So, what is our edge? Let's define this. So, if you think about it in terms of casinos, casinos have their edge on in every game, right? It's the math over a long period of time, right? This is a numbers game. Trading is a numbers game. So is blackjack, so is craps, so is roulette, right? The casino always holds the edge mathematically over the law of large numbers, right? Over a large sample size, the casino will win every time. That doesn't mean that you will go in and not come out red. You could easily beat the house, but with everybody combined that visited the casino that day, it equals out about green for the casino over a large sample size. So our edge basically is, and we'll get more to kind of the details on an edge down here, but an edge is basically, it's nothing more than an indication of a higher probability of one thing happening over another. So for me, that could mean I'm waiting for a level break with a 5-minute candle closing beyond my level, right? That could be considered my edge. Or I'm waiting for a retest of my level after, say we gap up. I want the price to come back down to my level and I want it to test. And then if it bounces and I see a couple ticks upwards off of that, old resistance becoming support now, I see that slight bounce, boom, I enter, I take my position and calls. That is my edge. Okay. So, but the thing is it's objective. There's no subjectivity to this. The rules are check boxes. I have my rules that I come into the day with every single day, and I'm not changing those up based on what I'm seeing. I'm letting the market define whether it checks my boxes or not. Okay, we're objectively identifying the edges. Number 2, I predefine the risk of every trade. I think the one of the first mistakes that probably every trader makes, and not only, within each trade, but why did you start trading in the first place? You don't start trading because you think, oh, I'm going to go and I'm going to pay a lot of, market tuition and just lose a bunch of money for 5 months. And then I'll start being green after I really understand what's going on. Nobody thinks that. Everybody's thinking, I'm going to come into the market, I'm going to work really hard at this, and because I'm working really hard, I'm going to make money. Okay, that is very false, right? You can work as hard as you want to, doesn't mean you're going to make money. So, but if you take that, you bring it to, every single trade, I predefine the risk of every trade. That's what this is saying. So, similar to that mentality that I just spoke about, if you're predefining the risk of every single trade, you're not just saying, okay, well, I want, if I'm buying these NVIDIA 287.5 calls and NVIDIA's at 286, I'm not thinking, okay, I'll scale when NVIDIA gets to 287.5. Instead, you should be thinking, okay, if NVIDIA gets to 285, I am cutting my entire position for, minus 15%, right? That is what you should be doing. You have to come to terms with the possible risk. Third, I completely accept the risk or I am willing to let go of the trade. Okay, so back to kind of what number 2 is saying, you must completely accept it. You must not only predefine it, but you must accept it. You can predefine a risk without completely accepting it. And what I mean is, I can say my stop loss is going to be minus 10, minus 15%, right? However, do you truly accept it? Okay. Let me kind of put this into an example. So say you have a maximum amount of positions you're going to take every day. Say it's 5 positions, okay? And then you say your maximum stop loss that you're going to take on those is, say, 10%. And say you're using 5% of your account for these trades. So if you're using 5% of your account for every trade and say you lose every one of them, right? So that would be 5 trades at minus 10%. If you're unable to come to terms with that collective loss, then you should think about 2 things, right? You should think about, number 1, either sizing down, because if you can't come to terms with the possible losses, you should be assuming based on rules 2 and 3 that you're going to lose every trade. Just have that in the back of your head. And if you can't come to terms with the, nominal loss that is going to produce for your account, based on your rules, then you should think about 2 things. You should think about sizing down, number 1, or taking, less positions, or maybe having a tighter stop loss, or any number of things. But I think the most important one is sizing down. Say, if you're unable to come to terms with certain losses, for me personally, the best thing that I've seen is just sizing down. Okay, part 2 of number 3. You're willing to let go of the trade. To me, what this says is it's kind of a pride thing, because many of us will say, we'll see something and it's suddenly, it's up, right? It's up, say, 19.5%. And for me, I'm scaling at 20%. So I have my sell order already in. It's already predetermined. Like, that's my scaling point. And it's up 19.5%, and I'm trying to sell. I don't get my order filled. Okay, so that's a bummer, right? Now it comes back down. Now it's at plus 10. I'm like, okay, well, I'm not scaling because it was just up at plus 20%. Why would I scale here? It's about to go hit my first target. Boom, we're going to be great. Okay, suddenly you're break even. Well, you should have had your stop loss for break even to begin with. I should have, right? But then, then it turns into, well, so suddenly it's like, well, I was just at 20%. I'm still going to hold. I might even average down, right? That would be the worst case scenario. Don't ever do that, right? You have to be willing to let go of the trade if you realize it's not happening. There can't be any of this, oh, well, it was just there. It can probably go back. Because if you think like that, it's going to go, 19%, 0%, and you say, okay, it was just up there, and then suddenly it's minus 20%, and you say, well, what the heck happened? I just let a green trade go red, and then suddenly it's like, okay, well, you know what? I'm in this for the long haul. I'm probably going to swing it. Then it goes minus 40%, and then it's 0, right? This happens. This happens to all of us. So it almost comes down to our pride. Are we willing to let go of the trade if we realize it's not going in our direction? Because that can give you tunnel vision. This second part right here is almost one of the most important things of this entire video. Are you willing to let go of the trade? Are you willing to, let your pride take a step back and realize that you need to accept the loser? Fourth, I see this is an issue with a lot of traders. I act on my edges without reservation or hesitation. So here's the thing. If you're objectively identifying your edges, meaning that you're checking the boxes, all the boxes get checked, you've predefined the risk, you've accepted the risk, you're willing to let go of the trade if you have to, why would you get analysis paralysis during the market while the actual trading is happening? If you've prepared levels or some sort of other strategy that you're going to execute on, whether it be EMA clouds or trend lines or whatever, if you have your edge and it's being presented to you based on your back testing or whatever, why would you act on it without? Why wouldn't you act on it without reservation or hesitation, right? The problem for many traders is that we'll have everything lined up in front of us and then we won't follow our intuitions. We'll see everything, all the boxes are checked, yet we won't take the position, yet we won't trust ourselves. Well, then what's the point of doing all the hard work in the first place, right? I often say it's the smartest people who struggle the most with trading. If you think, that you're an overthinker and then that's why you're struggling, maybe you are right. If you believe that you're overthinking everything, I would say think less. Have your rules, have the check boxes that you need to have filled. And if they get checked, you take the position because your risk is predefined and you're willing to accept it. And you're willing to let go of it. I mean, there's no need to be fearful if all of those boxes from 1 through 3 are checked. You must act your intuition, and you must you must act on your edges without reservation or hesitation. Okay. Number 5, there's a couple little points about this that I want to make. I pay myself as the market makes money available to me. Okay, number 1, to me, this speaks toward scaling, and this also speaks toward paying yourself, with your account. There's kind of two perspectives here that I like this for. So, first off, scaling, okay? For me, I'm taking my first third off generally around 20% gains, and I'm taking the next third off either at the next leg in my direction, or if it goes against me, I'll either stop out break even or stop out at plus 10%, right? And then the next third would be either the next leg in my direction, or I would end up cutting that at 10% or break even as well. So it all just depends on what the chart is doing, right? I'm not trying to dictate what's going to happen. However, I do have a plan for any outcome. So yeah, I pay myself as the market makes money available to me. So what this means is you're not waiting for the home run. This is basically saying base hits add up. This is Mark Douglas saying, hey, you get a base hit, you get 20, 25%. Why would you not scale some out? If the market is making money available to you, you must seize it, because it can take it away from you in an instant, right? If you see, if you're in a position and you are up, 25%, take off a third, take off a half, right? Because what is that doing? That's not only, it's not only taking your possible downside risk off the table, but it's also putting money in your pocket. So say you simply, sell half of your position at 25%, and then you set the rest for break even. Well, you can't lose, right? A lot of people struggle with letting winners run. And I think this is one of the most important things for that. If you can scale out some and then set the rest of your stop loss for break even, then it's stress free. I mean, you can literally walk away, go enjoy, outside, go listen to the birds sing, whatever. You can enjoy your day. So that's one of the most important points for people who don't let winners run. And then also paying yourself. I think it's very important that in this market, in everybody that trades, I think it's important to withdraw money on a regular basis. I know a lot of people have plans for paying themselves, resetting their account to a certain amount each week, but I think it's very valuable to realize that this money is not just numbers on a screen, like it's actual dollars. I struggle with that sometimes, and I think it's important for people to realize that, if you've made money, pay yourself. Sixth, I continually monitor my susceptibility for making errors. And so for me, what this means is if I make a big error, whether it be averaging down or whether it be FOMO, chasing, I am writing this down. I'm not somebody who really tracks my trades. However, what I have always tracked is my mistakes. So I'll track big mistakes that I make and or rule breaks, right? I'll write them down, and then over time I'll see that these rule breaks or these big mistakes, if they recur, then I get a sticky note and I post it on my monitor, and to remind myself that these are my rules and I don't break them, right? And then that leads us to number 7. I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Because if you go through the mental and psychological warfare of putting together 1 through 7, then you must abide by them. I mean, it's hard to even get to number 4 on this list, right? But once these all kind of start clicking in your head, it's you will realize that this is the only way you can win. This is the only way that you can be successful. Identifying your edges, predefining the risk, accepting it, acting without reservation, paying yourself as it becomes available, and then continually monitoring and adapting to what is happening within the market, because this is an ever-changing market and you can't ever expect that what happened yesterday is going to, dictate something that's going to happen today. Future or the past will sometimes look like the future. Sometimes it will do the same thing, but this is what leads us to the next set of bullets, which is very important. Just because, on December 20th, SPY looks just like it did, in the first week of January, and then the next two candles looked really similar, it doesn't mean that the next day is going to look exactly the same, right? As much as we want there to be repeated patterns, it's impossible to not only expect that, but you put yourself in the wrong frame of mind by expecting that. So, number 1 here, anything can happen. If you want to read 5 things to yourself before you start trading every day, it's these 5 things. Anything can happen, right? Anything, truly. So, if you're in a position and you think the market is reversing, suddenly an embassy could get attacked, right? That happened just last week. You have to be aware that any number of things can happen, especially with all of the crazy stuff going on with the Fed, policy changing all the time, speakers all the time. You have to be prepared for this, realizing that if you're in a position, or even if you're watching and not in a position, anything can happen. Okay. You don't need to know what is going to happen next in order to make money. This is what I tell people who overthink everything. You don't need to happen next. And if people ask me, what do you predict for this? What do you predict for that? Why this, why that? You don't need to know what's going to happen next in order to make money. That's why I do both call and put triggers. That's the reason that, we're looking at the market and we're letting the market dictate what we're doing. Don't come in with a bias, right? You don't need to know what's going to happen next in order to make money. Simply watch what's happening. Take it all in. Use that to make your decisions for you. I mean, the market is just an object, right? It's going to act in its own certain way, and just because you're in a call position doesn't mean it's going to go up, right? And then this leads me to number 3. There is a random distribution between wins and losses for any given set of variables that define an edge. This is exactly like a casino, right? The casino realizes that the people will win sometimes, the people will lose sometimes. That's okay. But over a long period of time with a large sample size, the casino generally always wins. Okay. So, what does that have to do with number 2? Well, you don't need to know what is going to happen next in order to make money, right? And that's because when you have an edge, there is a random distribution of wins and losses, right? You can't say, well, just because I think this is super high confidence, it's going to go in my direction. Oftentimes, the setups that look the best to me are the ones that don't pan out like I thought they were, which is so counterintuitive, but it's the truth, right? That's why I always speak to consistent position sizing. Like, don't size up heavily on something just because of how confident you are. I think every single position you take, I mean, of course, there's exceptions, but every single position you take, it should be considered in your mind high confidence. And why would you not take the same position sizing on every single trade? Like, why would you take medium confidence trades? I mean, I understand the want to, maybe take like a 10% scalp here and there. And I do it all the time. Like, I don't always consistently position size, but just from a general perspective, everything that you take should be high confidence, and you shouldn't be, double or triple sizing on something just because you really, really love the setup. Okay. That's that contradicts number three here, saying that there's a random distribution between wins and losses for any given variables that define an edge, right? You must accept that every outcome is basically a random distribution. However, you believe that your edge gives you that probability, right? So that gets you to number four. An edge is nothing more than an indication of a higher probability of one thing happening than another. So if you get all of your check boxes checked, right, then you say, boom, I have a 51% chance of winning this trade, right? Okay. You take it without hesitation, right? That is your edge, and you act upon it and you follow your rules. Okay. And then number five, every moment in the market is unique, right? You need to understand that, number one and number five kind of blend together for me a lot of times. But what's special about number five is that every moment in the market is unique. It's not just saying that, even though this looks like some past occurrence, doesn't mean it's going to happen again. Just because of that, it doesn't mean that there's only two outcomes. There if every moment in the market is unique. To me, that means that there is infinite outcomes. There are You can't even imagine or fathom the possibilities of what could possibly happen in the market. And so I'm a big fan of, having low expectations so that I leave room to be, impressed, right, by some certain situation. So if you come into the market realizing, number one, that anything can happen, and number five, that every moment in the market is unique, you're honestly not caught off guard by any sort of weirdness that could happen, because if even if you've traded for a month, you've already seen just some very weird things happen. I mean, it happens every day, right? Every moment in the market is unique. Okay, so I'm gonna wrap this up. I really hope that everybody spends a lot of time. If you want to watch this video regularly, I would highly recommend it. I look at these, two pictures, right? These are from my own copy of Trading in the Zone by Mark Douglas. Uh, I look at these two pictures and I read them, if not daily, every other day, right? They're so important to get your mind in the right place. You have to keep your expectations, and you have to keep your mentality and your mind. Everything needs to be in check. Trading is basically psychological warfare. And if you don't have your head in the right place, I mean, I argue that it's about 90% of the entire trading journey, right? It's all in your head. So if you can get your head in the right place, then that's how you become a consistent winner. Thank you, everybody.